Behavioral finance is a branch of finance that applies insights from psychology, neuroscience, and sociology to explain how investors deviate from rationality and how this affects market outcomes and opportunities. In this section, we will explore some of the key concepts and findings of behavioral finance and how they can help us understand the behavior of quants and other market participants. One of the main themes of behavioral finance is that investors are subject to heuristic-driven biases, which are mental shortcuts or rules of thumb that simplify complex problems but often lead to systematic errors or irrational judgments. For example, investors may rely on the availability heuristic, which means they judge the probability of an event by how easily they can recall similar instances from memory. This can cause them to overestimate the likelihood of rare events, such as market crashes or bubbles, or to ignore relevant information that is not readily available. Another common bias is the confirmation bias, which means investors tend to seek out and interpret information that confirms their existing beliefs and ignore or discount information that contradicts them. This can cause them to be overconfident in their own opinions and to stick to their prior views even when faced with new evidence. Another theme of behavioral finance is that investors are influenced by frame dependence, which means their decisions depend on how the problem is presented or framed rather than on the objective facts. For example, investors may exhibit loss aversion, which means they feel more pain from losing a certain amount of money than pleasure from gaining the same amount. This can cause them to hold on to losing investments too long, hoping for a recovery, or to sell winning investments too soon, locking in small profits. Another example of frame dependence is the endowment effect, which means investors tend to value something more once they own it than before they acquire it. This can cause them to demand a higher price to sell an asset than they would be willing to pay to buy it. A third theme of behavioral finance is that markets are inefficient, which means they do not always reflect all available information and may deviate from their fundamental values due to the collective behavior of investors. For example, markets may be affected by herd behavior, which means investors tend to follow the actions or opinions of others rather than their own analysis. This can cause markets to overreact or underreact to new information, creating bubbles or crashes. Another example of market inefficiency is the noise trader effect, which means investors who trade based on irrational beliefs or emotions can affect the prices and returns of assets even if they are not informed about the fundamentals. This can create noise or volatility in the market that can be exploited by rational investors. Behavioral finance incorporates insights from psychology, neuroscience, and sociology to explain how investors deviate from rationality and how this affects market outcomes and opportunities. By understanding the common biases and errors that affect human decision-making, quants can improve their own performance and take advantage of the mispricing and anomalies created by other market participants.